Hello, welcome back. Remember the days when I was adamant about buying Meta? Nothing could really change my mind back when the company's stock price was near $80, or unless something really bad happened with the company in regards to financials. I wouldn't be paying attention to the sentiment, the overall market sentiment, and this turned out to be a really good idea because the company's stock price at least skyrocketed in the past year. You can take a look at it here. Uh, a lot of people were talking about Meta going down and getting destroyed, decimated, and doing worse and worse, and then it started going on an absolutely massive run over here. Take a look at this one, beautiful. And yeah, it's one of the stocks that has done really well for me. And at some point it was near 80 bucks, and I was really adamant about buying more and was suggesting it in my channel in multiple videos. Now, the thing is, things change, and the stock price adapts, and the financials adapt too. So we want to be examining what is happening with Meta today and whether it is a buy, especially when compared to the rest of the tech companies, the big FANG. Now, I'm gonna be showing this chart here, and I've shown it in the previous videos because I think it's very relevant to all these tech companies, the big FANG companies, the outperformers, pretty much outperformers. Meta has done about 400%, and you may be thinking to yourselves, okay, this is less than most of this. Like, it's only Alphabet that has done less, compared to the S&P 500, which has done 128%, each one of these has done tremendously, with Apple pretty much getting the crown, having done the best of all these companies. So what about Meta, though? It's already done 400%, yes, but right now, in this kind of stock prices, this is a buy. If we take a look at the 6-month chart, actually let me take a look at the 3-month chart, it's still coming off of lower values, like 260 for instance. So it has been growing and growing without any declines really in this period. Again, you can see it in the 1-year chart. There has been a slight decline, frankly. At some point over here it was like 3 to 7 for instance, and maybe a little bit more. But overall, there hasn't been much of a decline. And also here, I think it was like 370 something at some point. No, actually, it hasn't reached that price. But anyway, yeah, it has reached about 330, 340 maybe at some point. Okay, the thing is, it's getting a little bit more expensive, it looks like, because right now we're sitting at a 36 price to earnings ratio and a 42 price to free cash flow. Remember, this is significantly more than both Google and Apple, and I'm not a big fan of that. Even though I like Meta, and I think they're gonna be doing really great in the future, because I also like their business model, for which I've talked about in multiple videos. I love when companies don't have a lot of upfront costs, and they can generate money through targeted marketing, because targeted marketing, for instance, the groups that Facebook has, is gold for advertisers. This is how you're finding potential customers. You want to be having targeting. You want to be targeting targeted customers, right? So if you are selling scuba diving equipment, you want to be finding groups of scuba divers, and this is what Google does. This is what Meta does with its groups, for example. Same thing applies for Google. Applies to Google, for instance, with their specific channels that are generating revenue out of specific groups of people. This is very key to advertising, and I'm always in for that. When you compare it to something like TikTok, TikTok could be making a lot of money because of non-targeted advertising, but it's much lower compared to when you are trying to sell something to a specific person who is watching a specific video for a specific reason, like fishing, for example. Like TikTok is about entertainment, which can still make money, but typically tends to pay more in regards to advertisers, because if I'm an advertiser, how can I advertise, for instance, let's just say pranks? It's going to be tough, right? Well, it's going to be much easier to advertise targeted audiences. It may be a little bit different when we're talking about cosmetics, for example, but still you get the idea. Now, the company's outstanding shares also going down, again following the trend with all these tech companies pretty much buying back their shares, which made a ton of sense. When the stock prices really suffered, they were down, they kept buying and buying, which made a ton of sense. Right now, I'm thinking that it may be a little bit more expensive. We're going to examine if that's the case, of course, with our discount cash flow model, see exactly how expensive or how cheap it is, because that really matters. And in regards to liabilities, the company has very little, because they are making tons of money. And so when you are making tons of money, it's fantastic, because apart from the fact that your investors love it, you don't really have to get extra debt. You don't really have to get a debt unless that debt has lower interest, and you can use it to increase your revenue at a tremendous point, at a much higher point, and your net income as well. But you don't really have to, is the thing. And you also don't have to issue new shares because you don't really have to fund yourselves. Some companies do that regardless of them being profitable if the stock price is way too expensive though. And that also makes sense. And as a shareholder, I actually applaud that because I do want to be offloading stock at an expensive price, even if I'm a stockholder. Now, the revenue growth of the company, 108%, 5% is the net income growth because it has been suffering. We know about this one. But kind of going back to normalcy, which we'll have to see, 24% for the free cash flow growth in the last 5 years, that is, in 5 years total equity growth, about 50% as well. Now, you will see here that the net income margin is a little bit of a weakest link compared to, like Meta is the weakest link compared to Google and Apple. This is another reason why this company may not be a buy right now. The fact that they have lower margins. Well, typically they have higher, significantly higher. Remember, it's advertising, right? It's software business, pretty much. They don't have too many upfront costs. Now, let's take a look at what they have been doing in regards to their financial statements, income statement, first with 10 years of display, just to have more data. 7.8 billion to 116. This is tremendous. Like, think about this one, about 8 billion here to 116. That's an insane increase here, more than tenfold increase. Absolutely amazing. And 1.5 billion to 23 billion, again, an insane increase in the past 10 years, pretty much. So the company definitely made a lot of sense in regards to the stock price, increasing that much. They have been doing tremendously well. Balance sheet, total equity, 84. Actually, let me take it to 10 years as well. And you will see that the company started with 15 billion, almost 16, and grew to 125. This is a mine, a gold mine, pretty much. They are almost printing money, or at least they have been printing money. That doesn't really guarantee that the company is going to be doing the same in the next few years, of course, because you never know with any company. But so far, they have shown incredible resilience, and also they have been making tons more money every year. Apart from, the pandemic years, which have been a burden for most companies, pretty much. It has to come with overall economy being at a solid pace as well, right? Otherwise, no company is going to be doing great if the overall economy is not doing great. That's a given. Now, the cash flow that the company has been generating, the free cash flow, 15 billion. Again, let me take it to 10 years. I forgot. It's 2.8 billion to 19 billion. Again, a fantastic increase here. Company been producing a lot of income, translating to operating cash flow. And then the thing that we knew about, they increased their capital expenditures tremendously at some point, minus 1.3 to minus 31. That was because of the metaverse. And this is when the stock price started to decline massively. And this is where we found an opportunity to be buying, of course. The previous opportunity was in Cambridge Analytica scandal, when I bought, for example. And these opportunities for Meta have been really great, and people who actually took up on these ones, they definitely made some money, or they are up a lot on their investments. Okay, what about the free cash flow? That's the free cash flow evaluator, pretty much, the discounted cash flow model. The company's revenue growth on average has been 25%. But that's something that is not going to be continuing forever, understandably so. Now, this company is not at a point that's approaching like Apple's revenue, which is like almost half a trillion, but it's still up there. It's like 116 billion. It's a lot. And they have been increasing at a tremendous pace every year. With our projections, we don't want to go that high because we don't know if they're going to achieve it. We want to be safer. So we can still have a relatively high value compared to what the company has been generating. And of course, if you are a Patreon and you have access to our tool here, myinvestorsheaven.com, if you are in the Patreon, you can become one actually by visiting this link, or just click on the description box below the video. There's a link. You can try all your estimates, different types of scenarios that you have in mind for potential revenue growth, net income margins, whatever, based on what the company has been doing in their past, because this little table here, which I found super handy, gives you the history of the company the past 5 years, so that you know what kind of values to use, and also gives you the averages, which is super handy. So I'm going to go 10, 12, and 14 here. It may be slightly aggressive, for some people. But again, you can try your own values. Net income margins, that the company has been going up and down a lot, recently going close to 20%, but for the most part has been 30. So I'm going to go in between those. I'm going to go 22 25 and 28. And if the company goes back to their normal years, it could be even higher, like 30%, for example. Free cash flow margin, similarly, 80, 90, 100%. That's very typical for most companies that are doing well, at least, in regards to the free cash flow. An annual return of 13% is what we're going to be asking for our discarded cash flow model. And now you see that the current price of the stock being at 315, the low value that we'd like to be buying Meta for, actually bought it for lower than this, crazy. 162, 225 is the medium, and 304 is the high. And the current price, again, 315. Now, you may be thinking to yourselves, Apple and Google in my videos were higher, like the high was actually lower than the current price. So it looked like a better buy. That could be the case, but maybe the revenue growth is a little bit aggressive here as well, because I used significantly lower revenue growth, which makes more sense, though, for companies like Apple or Google who are larger. And the company could be seeing maybe some years where the revenue growth is not 10% or 12%. And again, you could be trying this in your own projections, being a Patreon in our tool. And right now, with these kinds of projections, it's still expensive for sure, but it's not super expensive. However, it's coming off of a steep increase. Now, when a stock price pretty much is coming off of a steep increase, you may be thinking to yourself that at some point it will reverse. And yeah, in many situations it happens. But the thing is, a trend can be a really, really strong thing and can keep going on for a while, frankly. And so even if the stock price goes down maybe $20, $30, $40, it can come back with a vengeance and then go back up to $100, like up plus $100. The thing is, when we're buying as long-term investors and not really as traders, this one is probably not the best price for us. We may want to be waiting it out for a little while. It's not terrible. It's not like it's a price that is likely to lose people a lot of money in the future, but it's not the best. And so myself, I like to be waiting for sales, frankly. And all these companies, especially tech companies, are really, really affected by the overall markets and especially what happens with interest rates. And as it has been climbing lately, I'm not really that fond of entering right now. So I have examined Google, Apple, and Meta so far. None of these are actually a buy for me right now, to tell you the truth. If I absolutely had to buy one, it may actually be Apple, to tell you the truth. If I just had to. But if you ask me if I'm buying any, no, I'm not buying any right now. I'm waiting it out, see what happens in the next maybe few months or so. It's just not the time for me. Thank you for watching, guys. Do tell me which one you would be buying, Apple, Meta, or Alphabet, between these three. And again, I'm gonna be coming back with more fun stocks. Probably Netflix is going to be the next one. Thanks for watching. I'll see you in the next video. Bye-bye.